You've got to watch this before it's too late. With prices on the rise across the board, many of us are feeling the pinch in our wallets, but how did we get here in the first place? Jordan Peterson and John Anderson, who is the Deputy Prime Minister of Australia, do an all-around showcase of this issue and bring many interesting points into light, ranging from soaring inflation rates to examining the aftermaths of the 2008 financial crisis. But before I get back into it, let's watch this.
The evidence that relatively unconstrained government spending produces inflation seems to be incontrovertible. And then we might want to discuss exactly what inflation does to people. So inflation makes each unit of currency purchase less units of value.
Too much money chasing too few goods.
Exactly. And then you might say, well, who does that punish?
Yeah.
And the answer is, well, inflation punishes people who've been wise enough to forestall gratification.
Yeah.
Right? So if you're somebody who has been sensible and taken the medium to long-term into account, and you've saved money, so accrued wealth, let's say, and the sort of wealth that enables you to have a house and air conditioning and some opportunities for your kids, we would generally regard that as a social good, right? Because we hope that people who are not profligate and impulsive and who put a little aside for the future, for future contingencies, so that they can take care of themselves and others, those people should be valued. And if you inflate the currency by overspending, then those are the people who are preferentially punished. Because the people who spent all their money, well, they don't have any money. Inflation only affects them tangentially, but it destroys the wealth of the very people whose careful and conscientious striving have produced wealth to begin with. Yeah. And that seems inevitable. I mean, we've really seen that inflation break out across the Western world to quite a remarkable degree, even a degree that was unforeseen by the central banks, who claimed that they had it under control. I don't know what inflation is running at in Australia, but I know in Canada, I think on the food front, it's about 8% right now. And on the energy front in Europe, it's far higher than that. That's not all because of government overspending, but it's certainly contributing to that. So inflation punishes exactly the people who should be being rewarded by taking a medium to long-term view. And it differentially benefits people who were impulsive and profligate in their spending. And so that seems like bad social policy as far as I can tell.
Before I go on with the video, this is a good time to subscribe if you're interested in the discussions. We continue going back to Keynesian economic principles and ditching the free market economy that helped us in getting out of many tough periods during our recent economic history. Many on the left think that increasing government spending accompanied by an easy monetary policy and increased borrowing is a combination that cannot fail, except it fails, and when it does, things get ugly. You want proof? Well, the 2-year sudden double-digit inflation across Europe has made living conditions much harder for individuals. One of the primary drivers of the recent inflation has been supply chain disruptions caused by the COVID-19 pandemic. Lockdowns, restrictions, and disruptions to global trade have led to shortages of raw materials, components, and finished goods, causing prices to rise. Additionally, government stimulus payments and enhanced unemployment benefits have injected additional cash into the economy, further fueling consumer spending and worsening inflation. Expansive monetary policies pursued by central banks worldwide have also played a significant role in driving inflation higher. In response to the economic downturn caused by the pandemic, central banks implemented unprecedented measures to support the economy, such as slashing interest rates to near zero levels and engaging in large-scale asset purchases. While these measures were intended to stimulate economic activity and support financial markets, they have massively increased the money supply, and excess liquidity in the financial system only leads to inflation. If we take a closer look at the United States case, we'll see that the issue's far worse. The government constantly keeps hitting the debt ceiling, which is the limit imposed by the Congress on the amount the government can owe, without having a clear mid- or long-term economic plan in sight. That's one of the main reasons the credit rating agency Fitch downgraded the US rating from AAA to AA+, stating, quote, "Repeated debt limit political standoffs and last-minute resolutions have eroded confidence in fiscal management, and that the government lacks a medium-term fiscal framework unlike most peers and has a complex budgeting process."
I agree with all of what you've said, but I think it's really important to understand that it's actually we've done something worse than that. Because what happened was that Australia went into the great financial crisis. I don't know whether you use that term internationally, but that's what we call it here. The meltdown, Lehman Brothers.
Yeah.
A real story about the link between culture and good policy outcomes. That one was, because they didn't break the law, but by gee, they broke the spirit of everything that was decent. Mm-hmm. and these are important things. Where's personal responsibility? Where's decency? Where's doing the right thing in banking more important than making an instant bob? But leave that aside. Most countries actually were starting to worry about their debt to GDP ratios in the build-up to the great financial crisis. They were starting to try to do something about it. Take a line through it, was around 35, 45, 50% in a lot of Western countries. And they were saying, this is getting, need to wind it back, prepare for a rainy day, these are good times. They were right to do so. Then the Lehman Brothers, unsound money everywhere, exposed all over the place. At one stage, the system nearly collapsed at one stage. So governments did extraordinary things. The government of America bought General Motors and Chrysler from memory. I don't think they bought Ford. Governments everywhere bailed banks out.
Insurance companies.
All that debt went onto the public sector balance sheet. The private citizens suddenly owed, in theory, owned General Motors.
They call that privatizing profit and socializing risk.
Yeah, well, I'm an Australian farmer. We sometimes get accused of wanting to do that here. But I would push back against the charge that all farmers are guilty of it. But that's right. However, what then followed was that governments looking at this mountain of debt say, what do we do now? Because the discipline, you asked, let's come back to how we did it, of tough decisions. There was no stomach for it. Matthew Paris wrote, at the time, face it, we're broke. We've overdone it. We're all going to have to live much lower living standards because none of us have got the stomach, to do the hard work to wind back this debt that's going to be so bad for our kids.
And you know what the absurd part is? The underlying issues that led to the 2008 financial meltdown were not fixed. Instead, they're even more acute now. One of the primary factors contributing to the continued vulnerability of the financial system is the phenomenon of, quote, too big to fail institutions. In the aftermath of the 2008 financial crisis, many large financial institutions were deemed too big to fail and received massive government bailouts to prevent their collapse. However, instead of addressing the systemic risks posed by these institutions, government intervention and regulatory reforms have only served to reinforce their dominance and concentration of power. As a result, these institutions now wield even greater influence over the global economy, making the financial system more vulnerable to system shocks and instability. Another critical issue that has intensified since the 2008 financial crisis: the growing interconnectedness and complexity of global financial markets. The rise of globalization and the integration of financial markets have created a highly interdependent and interconnected system where shocks and disruptions in one part of the world can quickly spread across borders, and this can amplify the risks. This interconnectedness has made it increasingly difficult to contain and mitigate financial crises, as the spillover effects of disruptions in one market can quickly echo throughout the global economy. A clear example of this is how three major technology-focused banks in the United States failed: Silvergate Bank, Signature Bank, and Silicon Valley Bank. Now, SVB had branches in multiple countries, which made this issue far worse, and the US Federal Reserve was quick to step in and take over the bank, announcing a massive bailout package, with HSBC taking over SVB's UK subsidiary. But things didn't end there. Banks across the world were under stress, especially in Europe, seeing their share price drop. That's when, in the weeks after, Credit Suisse was under massive stress, and the Swiss government had to step in and facilitate UBS, requiring it. If it wasn't for government intervention, we would have had a worse result than 2008.
What governments did then is they looked for inflation, because inflation devalues money and makes the debt smaller. And they looked for it and they pumped money into everything. We had very low interest rates for an incredible period of time. We pursued endlessly quantitative easing, which is basically printing money in a fancy way. It's always ended in tears. Think Weimar Germany. And people kept saying, where's the inflation? We want the inflation to devalue the government debts to get it under control so that we don't have to cripple people with taxation. But the inflation was there. Was in asset prices.
Right. Housing prices. And
who did that hurt? Where's the social impact of that? It's in housing prices, especially for young people in this country. It really, really worries me. When I left school, I'm a bit older than you, Jordan. I mightn't look it, but I am. And when I left school in the mid-70s, an average Australian house cost 4 times average annual earnings. Today it's 11 times, and in Sydney and Melbourne it's more like 13 times. Now that impacts a lot of things. Social cohesion, I would argue it impacts. Perhaps more seriously and related is family formation. Mm-hmm. In a time when 92 countries in the world have collapsing populations, and we haven't realised how difficult that's going to be to handle. Mm-hmm. So I think it's a very dangerous story all round. And again, I say to you, I actually have a lot of sympathy for modern politicians. I could say to them, you've lost your philosophical heart. Where are the great strands of thinking through which you used to look through to see, will this policy advance or take backwards my dream of what the country ought to be? So I could be harsh at that level. But at the other level, I'd say, we've not been prepared to delay gratification, to make tough choices, to say, yeah, look, we want to elect a government that'll do some hard things for our kids' sake to get the whole show back on the road. And here in this country, we've had a minerals boom. We're back in debt. Our debt to GDP ratio now is creeping out. Over time, it will get out to around 40% on current projections. 40% is the level at which those European and American countries started to lose control at the time of the GFC. This stuff matters. Mm-hmm. And as interest rates rise, more and more taxpayers' money's just going into servicing the debt. So it's not buying hospitals or looking after schools or providing reparations to countries for climate change damage, all of those things. That's all going to be debt financed from now on. Mm-hmm. And who's going to pay that debt?
How are people supposed to get married with higher cost of living and projections for continued high inflation? People's purchasing power is diminishing year after year. That's why younger individuals are increasingly finding it difficult to afford the expenses related to starting a family and maintaining a house. The 2021 census in the United Kingdom found a big fall in the number of young people getting married, particularly those aged between 25 and 35, with 1.2 million more people unmarried in that age bracket than were in 2011, and more than double of the figure stood at 1991. The Marriage Foundation, a charity that promotes marriage, said the social pressure to marry in the UK had, quote, pretty much disappeared, adding, quote, the decline of marriage is much less obvious among high-income groups. In such a challenging economic environment, individuals and couples face difficult trade-offs and sacrifices as they prioritize financial stability and security over personal and familial goals. The prospect of getting married and starting a family become increasingly difficult for many people, leading to lower marriage rates, postponing or giving up on parenthood altogether, and changes in societal norms and expectations regarding relationships and family life.